Hi everyone. Thanks for joining this call on RBI monetary policy. So today we have Mr. Suyash Choudhary, head fixed income with us to share his views on debt market and on today's monetary policy. At this moment, all participants are in a listen only mode. Do note that this conference is being recorded. Also, please note mutual fund investments are subject to market risk. Read all scheme related documents carefully. Over to you, Suyash.
Thank you, Abhishek. Good evening, everyone. Please let us know if I'm not audible and visible. Let me start. What we thought we'll do today is just recap very quickly, the last few years, because this is a bit of a turning point as far as monetary policy is concerned. And in that context, evaluate, what we think is happening with RBI, what we think the immediate future of monetary policy is, and what we think the fixed income view and the good trades in the market are. I'll also just very briefly touch upon and reiterate some of our points with respect to the so-called Trump trade and global market expectations. So as you would know, today the CRR was cut by 50 basis points to be done over the next 2 fortnights in 25 basis point lots. Cumulatively, it will release around 116,000 crores of liquidity into the banking system. The repo rate was left unchanged with a 4-2 majority, which means that one more external member has joined the rate cut bandwagon. The outcome was pretty much as per expectation. So post, the weaker GDP print recently that we received at the end of November, combined with the liquidity drain that we have been facing, which I will cover shortly in more detail, most of the market was coming around to the view that some significant liquidity measure was required. And, the only real large, immediate, significant liquidity measure you can take is CRR. And therefore, it is pretty much as per market consensus. Let me now turn to, what I said, just a brief recap of the last few years. So, you'll remember that, this is something that we all know and appreciate, that if you're an emerging market who doesn't print one of the reserve currencies of the world, the macroeconomic boundaries of what you can do are tighter than if you're a developed market and who prints the reserve currency. So, as an emerging market, you always have to have one eye out for macro stability. And there's only so much expansion of fiscal and monetary policy that you can do. Now, if you think back to, the COVID response that, let's say, India had versus the US. So India was very much more measured in their fiscal and monetary response, which was for two reasons. One is that India correctly assessed that the COVID represented a stoppage of time and not permanent damage to output, and therefore you had to handhold the weaker segments of both the corporate and retail sector as activity started again. The US, on the other hand, threw the whole fiscal bazooka at the problem, and one of the reasons was that they could. And as a result of which, two things happened. One is, the macroeconomic stability parameters recovered very quickly in India, not so for the US. But also because, had COVID not happened and you had sustained a 6 to 6.5% trend growth rate for India, the cumulative output that you have posted by now would have been roughly 8% higher than the cumulative output you have posted till date. So let me repeat, had COVID shock not happened and you hadn't, that 1 year of massive output degrowth, and you had chugged along at 6.5% annual real GDP growth rate, the cumulative output that you would have posted in this period would have been around 7 to 8% higher than where you are today. In the case of the US, however, there was no such thing because they were aggressive with their fiscal response, a shade too aggressive as most people think, and they recovered all the output lost and more. But not so the case for India. Now, which means that, we need a period of trend or above trend growth to continue for us to continue to recover this cumulative gap in output. Simply also because, the labor supply is increasing at a fixed rate per annum. But if there is still a shortage in the cumulative output, there is therefore a gap between, the demand and supply for labor as well. So, what government and RBI have done in order to ensure that we continue to sustain growth is they have been very proactive and nimble in macro policy management. So you would recall that RBI immediately started to hike rates in, after the Russia-Ukraine war. Most of their liquidity items were self-expiry. The government, once the crisis was over, consolidated their fiscal accounts and reoriented spending towards more of capex spending and so forth. So the macro economic stability that India purchased has allowed us to grow at or higher trend for a longer period of time. So that's one point that needs to be noted in context of that if growth were to now start to weaken, the sensitivity around that weakness is going to be slightly higher because there is still a cumulative gap in output since the COVID days. The other thing, that one has to note is that, had the US dollar and US rates risen and then started to fall again, then the degrees of freedom available for emerging markets like India to, accommodate more monetary easing, etc., would have been higher. But as we know, in the US, first the dollar and interest rates rose post-COVID because fiscal expansion was very large and monetary policy or Fed had to hike rates aggressively by 500 plus basis points. However, the strength of the dollar and relative strength of US yields has sustained even now for two or three reasons. One is that fiscal compression post the COVID crisis having passed in the US is still very low. So unlike the pre-COVID era when US fiscal deficit was around 3% of GDP, they are stuck at around 6.5% of GDP. And interest rates have continued to be higher. Growth has continued to be stronger, owing to lesser fiscal compression, more productivity jump, which is happening for US corporates, as well as expansion in labor supply. Why that matters is because the US dollar and US interest rate environment has refused to climb down, which continues to offer limited degrees of freedom for aggressive easing for countries, emerging market countries like India. Now, over the medium term, it won't matter as much because India continues to grow from strength to strength, but in the near term, it matters. And therefore, the policy, choices or framework that is available to RBI and government, as far as we see it, is basically this. You have to be careful because it is still a strong dollar and high dollar interest rate environment. At the same time, you have to be cognizant of the fact that since COVID, you are still short on cumulative output than you would have been had COVID not happened. And therefore, you have to strike that fine balance between, continuing to pursue prudent fiscal and monetary policy, as well as be sensitive to, any sort of growth slowdown that you may be witnessing. And we think we are now at that stage where the first signs of that growth slowdown are beginning to happen. And therefore, policy now has to walk that fine line, which is not to go overboard, but at the same time, start to do some bit of incremental easing. Now, let's turn to growth and discuss for a second. So RBI's view on this is that, Q2 growth was slower because of excess rains, because of, lackluster government spending. So after election, central government spending had rebounded, but not so much state government spending, especially in relation to capex. And as government spending picks up, as agriculture output, rises, as is very much expected, a lot of this growth will begin to come back, and we have cyclically bottomed out on growth. Now, while that may be true, there are also some medium cycle trends that are happening. So there are still cyclical trends, but basically a 2 or 3 year trends, which argue for some bit of growth headwinds. So the first and foremost there is, as you would know that over the last 2 to 3 years, a lot of India's consumption growth is leverage consumption growth. So there has been very large CAGR growth rates in personal loans, unsecured loans, even retail auto loans, etc., which has fueled a very large consumption cycle over the last few years. Now that is now decidedly slowing, partly intentionally because of regulatory tightening, and partly because banks and other lenders have grown more cautious. At a headline level, credit growth has subsided from 18-19% to now 11%. And clearly, all of this is already beginning to impact consumption. So the current narrative is urban consumption is slowing down while rural is picking up on better monsoons. But one of the key reasons why urban consumption is slowing down is basically because growth in loans is slowing down dramatically. The second point is, although business sentiment is so far holding up quite well, you will recall from the 2018-19 tariff experiment that as those tariffs come on stream, business investment sentiment globally tends to take a bit of a hit. And that could very well happen now also, especially because a lot of manufacturers fear that China will continue to seek to export their excess capacity to the rest of the world, including to India. So if you put that together, continued slowdown in credit growth and leverage consumption, as well as the prospects that the robustness of business sentiment may actually suffer some dent because of ongoing global developments, what we would think is the very short-term narrative that this quarter growth is going to be better is a very short cycle phenomenon. However, if you were to take a bit more medium cycle view into picture, growth is slowing down. And even if you see, the amount of growth cuts that RBI has instituted. So yes, Q2 financial year, RBI was at 7%. It actually printed 5.4. But even for Q3 and Q4, RBI has actually scaled down their GDP forecast to some extent. And for the full year, it's a substantial cut from 7.2% earlier to only 6.6% now. So that's an important point to establish. And in context of the initial remark that I made, that as growth starts to slow, monetary policy will have to be even more sensitive because they know that there is still a cumulative gap from the pre-COVID years to now. To be fair, although RBI and MPC are still very sanguine on growth, but they have very clearly opened the door on the idea that they may have to address a growth slowdown should it continue to evidence itself. So currently RBI thinks that it will come back very quickly. It doesn't look like it will. And as inflation starts to give them some room, we continue to think that the door is wide open for the first rate cut in February. What is also noteworthy there is, even though RBI has bumped up their inflation forecast for now, for Q2 FY26, they have projected a CPI inflation rate of 4%, which is exactly at their target. Now, clearly, they won't wait around for Q2 FY26 to implement the first rate cut. So the idea would be that if the near inflation prints are pretty much basis what they projected or on track from what they projected, then they would gain additional confirmation that Q2 FY26 will actually be closer to 4%. And with more evidence that growth, although rebounding from the last quarter, is not rebounding to the extent that one would have desired, we think the February rate cut is very much happening. That, basically leaves me to the liquidity argument, which is the more interesting thing what is happening in the market and which has basically precipitated the CRR cut today. So if you think about, most periods post-COVID, and especially the recent 10-12 months, what you have seen is very high core system liquidity of the order of 4 to 5 lakh crores. However, the headline system liquidity from time to time has fallen because of rise in government cash balances. So just to recall from a concept standpoint, the headline liquidity that we see on a day-to-day basis at liquidity adjustment facility level adjusts for government cash balance run with the RBI. But what we also focus on in terms of sustainability of the liquidity picture is what the underlying core liquidity dynamics are like. So to reiterate, what we have seen over the last few months and quarters is that the core system liquidity has been high at 4 to 5 lakh crores. But because of large swings in government cash balances, especially over periods when government has not been spending as much, you have seen fluctuations in headline system liquidity. Now, what the RBI needed to do in that was pretty clear. It was frictional liquidity management, short-term liquidity management, and therefore they deployed tools like VRR and VRRR to smoothen out these temporary shortfalls or excesses in liquidity. As opposed to that, what you are witnessing now is a rapid decline in core system liquidity. So just to put some numbers on the table, in the last 2.5 months, the core system liquidity has declined from somewhere around 4 to 4.5 lakh crores to currently at just 1 lakh crore prior to this CRR cut. Now, this 3.5 lakh crore drain is primarily on account of dollar sales by RBI, because over the last couple of months, dollar INR has turned very much more volatile, and also partly because of some balance sheet runoffs that RBI has faced, which means that securities sitting on RBI's balance sheets have matured over the last 30 odd days by something like 50,000 crores. But the bulk of it has to do with FX sales by the RBI, under which it sells dollars and buys rupees from the market. So this liquidity environment is very, very different from previous such headline liquidity dips, because like I explained, this is purely led by core system liquidity decline, and therefore has to be compensated by core liquidity infusion. Now, there are really only 3 or 4 channels through which core liquidity enhancement happens. One is, the annual dividends that RBI pays to Government of India, but that happens earlier in the year. It can't be paid just to shore up system liquidity. The two dominant tools are CRR cut and OMO purchases. And sometimes RBI uses the FX route, wherein it may actually buy dollars now and sell them forward, etc. But that is also a function of a lot of other market variables, including the state of availability of spot dollars in the system. So let's just focus, which is CRR and OMOs. Now, today, the RBI has delivered on 50 basis of CRR cut to be implemented over the next 2 fortnights, which will infuse 1,16,000 crores. But this is nowhere near enough. So just to run through some quick calculations, currently, like I said, we estimate that the core system liquidity is already 1 lakh crores. Over the next quarter, which is Jan to March, the system loses around 1,25,000 crores on currency in circulation rise. So had the CRR not happened, on its own, core system liquidity would have dipped to around minus 50,000 crores by March. Now, if you add the CRR of 1,16,000 crores, it means that core system liquidity would probably end March by 60 to 70,000 crores positive. That is assuming no further dollar sales by the RBI. However, even that 60 to 70,000 crore headline liquidity is very, very inadequate, because the government cash balance keeps swinging massively. So if the core system liquidity is only 60, 70,000 crores positive, it will mean that it will over and over again, the headline liquidity will dip into negative territory. So our reasonably strong view is that over the next quarter, the RBI will also have to do around 1 lakh crores of OMO bond purchases from the market. And this is just to ensure that the core system liquidity reaches a hygiene level of 1.5 odd lakh positive crores, so that the fluctuations in headline liquidity are better controlled. We do think that in February, the first rate cut happens, which means that RBI will have to step up liquidity creation even further in order to ensure transmission of that rate cut, which means that probably that 1 lakh crore OMO number is a bit conservative number. But as of now, we are happy to go with that, which is to say that the CRR cut has already happened. We think February is likely the first repo rate cut, which will be on the back of the near-term spike in inflation having subsided, and RBI getting further information that growth, although rebounding, is not rebounding to the extent that may have been desirable. And then we expect OMO purchases of around 1 lakh crore between January to March. Now, these throw up very interesting times for the bond market. So first, for the SLR curve, which is government bonds and to some extent state development loans, this further improves the demand supply environment. So, and this is specifically true for government bonds followed by state development loans, because bear in mind, there is a Q4 calendar for SDLs, which is also going to be heavy. But even accounting for that, with this fresh OMO purchases, the demand supply for SLR gets even more compulsive. So that's point number one. And we continue to think that any duration that investors are building should be through SLR, chiefly government bonds. The second related aspect is that, as we have talked before, the corporate bond curve continues to be inverted, although the level of inversion has declined to some extent, which is to say that rates at the 1 year, 2 year points are higher than the rates at the 5 year, 10 year, 15 points on the corporate bond curve. Now, what will also happen, we think, over the next 3 to 4 months is the inversion in the corporate bond curve will start to correct itself. And especially from the April to June quarter, we expect to see a reasonable fall in the 1 year, 2 year rates in the corporate bond market, including in bank CDs. Now, this will be basis a few factors. The first is the credit to deposit ratio imbalance in the banking system is largely behind them. If you see incremental growth rates of credit and deposit, they have converged. If you see the year to date accretion in credit versus accretion in deposits, or disbursal of credit versus accretion in deposits, deposit growth is much higher in absolute terms than credit growth. And from April, we will hit lean season on credit, which automatically reduces the demand for credit. Plus, like I said, we expect RBI to increase the pace of liquidity infusion. Plus, we think February is due for the first rate cut, which means that for investors wanting to build a front-end book, which is, let's say money market funds or short-term funds, etc., the best time is probably between now and March. And beyond that, you should expect rates to start to fall from there. So in summary, the US exceptionalism ensures that the degrees of freedom are limited for emerging markets, including India. At the same time, India's macro story has been strong, and therefore it has slightly better degrees of freedom. There is still cumulative output gap to be made since the pandemic, because we didn't have the luxury to indulge in aggressive fiscal and monetary policy at that point in time. And therefore, a growth slowdown will be that much more sensitive to policymakers, including RBI, because it means that will take that much longer for that cumulative output to be made up again. We think we are now at a time where growth is expected to slow, although it will recover from the 5.4 published in Q2, simply for the reason that leverage consumption is slowing and business fixed investment sentiment may probably take a dent at some point in the near future. We think the RBI cuts repo rate for the first time in February and follows it up by another 50 basis points over the 1 year after that, so that in total they would have cut by 75 basis points, let's say over the next 1 year or so. We think post this CRR, there is still not enough measures taken as far as core system liquidity is concerned, and therefore we believe over Jan to March quarter, there'll be at least 1 lakh crores of open market purchases from RBI. There's just one caveat I'll put. If some sort of an FX purchase measure were to start to happen, so let's say there is a dramatic fall in the US dollar, INR starts to appreciate and RBI can actually recoup more FX and create INR liquidity through that route, then to that extent, the OMO purchase number can go down. So the assumption in the 1 lakh crore OMO purchase number is there is no liquidity enhancement through the FX route. And we believe this is a great time for SLR, duration building via SLR, and to start to receive front-end money market and corporate bond rates with a view that these rates are probably likely to fall significantly starting the April to June quarter. So this is, pertaining to the monetary policy strategies, etc. Let me just take a quick, 2-3 minutes to summarize basically some of the thoughts we had presented post Trump's election with respect to what we are thinking about the market. See, the underlying point that we are coming from is that, there is a swing that happens in the needle from one side to the other. And sometimes, as the needle is swinging to one side, all the extrapolations naturally tend to happen during, towards that side. I remember reading an interesting piece recently where it was mentioned that in the year 2000, US debt to GDP was just 32%. And the projections was that in the next 10 years, US government debt to GDP will become zero, which means that government will have zero debt outstanding in the next 10 years because the starting point was just 32% and nobody believed that US will ever expand their fiscal policy. What you're seeing today is exactly the reverse, where US printed 10 to 12% deficit for 2 years in the COVID period. They are still only down to around 6.5%. And therefore, the easiest projection to make today is that, look, with the Trump tax cuts, etc., this will only keep going up. It will go to 7.5, whatever those numbers are. In doing so, one is not paying enough attention to some of the expenditure cut policies that may potentially also be announced and put in place. As an example, the Treasury Secretary pick, Scott Bessent, has a 3x3x3 proposal that he has talked about, which is, and don't take this at face value, but just the direction that it implies. So it means 3% US GDP growth rate on the back of deregulation. It means the equivalent of 3 million barrels per day of additional oil or equivalent energy production. And it means 3% fiscal deficit by the year the current Trump presidency gets over, which is November of 2028. Now, again, like I said, don't take this at face value because the US fiscal deficit is at 6.5%. And it's very, very hard to cut that to 3% in 4 years' time. But the direction of travel matters because 70-80% of the market is just thinking about higher US fiscal deficit and higher interest rates even more. So if the direction of travel is that they take expenditure cut measures so as to start to contain the fiscal deficit, most of the market has not been prepared for it. Only lately have some people begun realizing that, and therefore US yields have been falling. Similarly, look at the argument that US interest rates can keep going up. That assumes that because so far nothing much has broken in the economy there, despite a 500 basis point rate hike, which is now still at 400 basis point plus, despite 7% mortgage rates, despite some tiers of consumer loans at 8%, etc., that these rates can continue to go up and nothing will break. Whereas the burden of proof is actually on people arguing for even further higher interest rates because the US is already a two-fold economy where, economically speaking, the bottom quartile is actually struggling even as we speak today in terms of real disposable income having fallen, in terms of interest cost, interest liabilities having risen substantially, and facing higher inflation. Whereas most of the economic strength that economy is projecting is pertaining to the top 30-40%. One can argue that that was one of the reasons why the last election was lost. And therefore, it's highly unlikely that a new administration comes in, spends 4 years to further accentuate this divide, to further accentuate higher interest rates, higher inflation, and higher fiscal deficit. The other point we have made is that there are offsets available around the world. So if tariffs are imposed, the Eurozone will have to cut rates aggressively. Already people are beginning to think about that. And remember, the Eurozone can cut by a hefty 200-250 basis points going ahead. The gap between German and US 10-year yields continues to widen, and at some juncture, even on a hedged basis, it may make sense for Euro investors to start buying US Treasury yields. Similarly, if you turn to China, the risk that people say is that China will aggressively devalue the yuan. The 2016 to 18 experiment with Chinese yuan devaluation did not go well for their external account. Their priorities have shifted. And we don't think there is any aggressive Chinese devaluation that is going to happen now. You hear as much from China policymakers as well that they don't favor much weaker yuan. So if you combine a lot of these things, the world is very different now than it was between 2017 and 19. You'll remember the Fed had hiked 200 basis points then. The Fed is not hiking, it's cutting now. The ECB was at minus 40 basis points of overnight interest rates then. It's at 3/4 and at tons of scope to cut right now. So things are very, very different now in this cycle. And it doesn't pay to keep extrapolating that same old trade of higher fiscal deficit, higher interest rates, as if nothing will break if that keeps on happening. So our view there is, there is global uncertainty as it always has been for the last 3 years, and it will be for the next years as well. However, the India story, as we just discussed from a bond market standpoint, is reasonably strong. We don't expect outlier global disruptions, which will allow local investors to keep building a quality fixed income book. And we think we are now at a point of inflection on RBI policy where permanent liquidity infusion picks up. The next channel is OMO purchases, which will do good things for demand versus supply. And the first rate cut is to be looked forward to in the very near future.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.